So, back in March 2026, something big happened. The Japanese yen, a currency that for decades was the very definition of stability, got hit with a massive credit shock. It was a perfect storm of geopolitics, dicey domestic policy, and some really deep structural problems that sent the currency into a total free fall. So, what happened? Let's break it down. By the middle of the month, the exchange rate just blew past a supercritical line in the sand, 159.4 yen to the US dollar. That's the weakest it had been since 2004, and it was a huge red flag for policymakers. The market was definitely sending a message, and it was a loud one. And that really is the big question, right? How on earth did the currency that investors always ran to for safety suddenly become a hot potato? This wasn't just some market blip. No, this was the world fundamentally reevaluating the entire idea of Japan itself. All right, so here's how we're going to tackle this. First, we'll dive into the energy shockwave that kicked the whole thing off. Then we'll look at the high-stakes gamble of Sanaenomics and the deep structural cracks known as Japan's digital cliff. And finally, we'll explore what the future could hold for the yen and how its whole identity is changing on the world stage. Okay, so the spark that lit this whole fire, it wasn't cooked up in some boardroom in Tokyo. Nope. It started thousands of miles away, right in the heart of the Middle East. So, picture this. Late February, a joint U.S.-Israeli military operation, dramatically named Epic Fury, just ratchets up tensions to a whole new level. And in response, Iran and its allies basically shut down the Strait of Hormuz, one of the most important choke points for global energy. And just like that, Japan's biggest weakness was suddenly out in the open for everyone to see. I mean, just look at these numbers. This shows you exactly how exposed Japan is. A whopping 95% of its crude oil comes from the Middle East. This is more than just a dependency, it's a massive structural vulnerability that's been sitting there for over 50 years. It's a bitter lesson they learned the hard way in the oil crises of the 1970s, but it seems like it was never fully solved. And this right here shows you the direct hit of that huge 95% of oil from the Middle East. About 70% of it has to pass through the Strait of Hormuz. All of a sudden, almost 2/3 of Japan's entire oil supply was at risk. So the yen, which everyone always ran to for safety, was suddenly seen by the market as, well, the sacrificial victim in this whole mess. Okay, so let's connect the dots. How does a problem in the Middle East crash the yen? Well, as oil prices skyrocketed to $120 a barrel, Japan's trade deficit was on track to more than double in just 1 month. The reason is pretty straightforward. Japan has to buy all that crazy expensive oil in US dollars. That forces Japanese companies to sell their yen to get those dollars, and that kicks off a vicious cycle where the yen just keeps getting weaker and weaker. But you know, that energy shock, that was just the spark. The real fuel for this fire came from inside Japan itself, a massive policy gamble called Sanaenomics. So after Prime Minister Takaichi won the election, she rolled out this whole new economic playbook. They called it Sanaenomics, and it was a total shift towards big government. We're talking about a decisive break from the past, prioritizing massive government spending to tackle everything from the cost of living to big national security goals. And man, was her agenda ambitious. I'm talking a 2-year freeze on the food tax, boosting defense spending all the way to 2% of GDP, and pouring huge subsidies into key tech sectors like AI and semiconductors. Now, on paper, that all sounds like it's about growth, right? But the market was seeing a completely different story. And this is why everyone was freaking out. Japan was already buried under a mountain of debt. We're talking a public debt-to-GDP ratio of 237%. It's one of the highest on the planet. So to then announce a huge new wave of spending and tax cuts on top of that sent a massive shockwave through the bond markets. Yeah, and this quote from Robin Brooks, a former IMF economist, just hits the nail on the head. Investors got seriously spooked by all this new spending, and they basically started to protest. They saw the yen not as a store of value anymore, but as a debt dilution tool, a currency the government would have to devalue just to manage its massive bills. Japan was caught in a classic trap. Okay, so we've got the geopolitical shock and the risky government spending. But underneath all that, there's a deeper, slower-burning problem that's been chipping away at the yen's foundation for years, the country's own crumbling digital infrastructure. This is going to sound crazy, but it's totally true. By 2026, Japan's digital cliff, this really slow adoption of modern tech, was a serious reality. Seriously, we're talking about almost 2,000 government procedures that still required physical media like floppy disks. And look, this isn't just some funny, weird fact. It's a symptom of a huge structural issue. And that problem? It comes with a huge human cost. By 2030, Japan is looking at a shortage of 450,000 IT professionals. You just don't have enough people with the modern skills needed to pull the country's digital infrastructure into the 21st century. And that creates a really dangerous dependency. So what you get is this constant two-way drain of money. On one hand, Japanese companies are paying these massive, rigid fees in US dollars to American tech giants for cloud services and software. And on the other hand, because they can't find enough local talent, they're forced to outsource their development work, sending even more capital overseas. Put it all together, and you've got this relentless downward pressure on the yen, no matter what else is going on. So you've got these three huge forces crashing into each other: the energy shock, the risky policies, and this digital decay. The big question is, where does the yen go from here? Well, analysts are basically seeing three possible paths for the rest of 2026. All right, so the most likely outcome, sitting at about a 45% chance, is that stagflation just gets worse. If the conflict in the Middle East drags on and oil stays high, the yen could weaken past 165. Then you've got a more hopeful path, about a 35% probability, where things cool down geopolitically and the yen strengthens back to the 145-150 range. But then there's the scary one, a 20% chance of a total fiscal crisis, where the bond market collapses and could send the yen crashing past 180. Look, whatever path Japan ends up on, one thing is absolutely certain. This crisis has permanently changed what the Japanese yen is and what it represents in the entire global financial system. Think about it like this. The old yen was your safe haven, right? The currency you bought when the world got scary because its value was tied to Japan's stability. But the new yen, it's the complete opposite. Its value now is an inverse proxy for physical things. So when the price of real stuff like oil or gold goes up, the yen's value goes down. It's basically become a bet against global chaos and scarcity. So really, the biggest takeaway here is that the game has completely changed. The yen's value is no longer a simple math problem about interest rates. It's now a direct reflection of Japan's energy security, its credibility with its own debt, and, frankly, how well it can handle itself in this increasingly messy, fragmenting world. And all of this leaves us with a much, much bigger question, one that goes way beyond Japan. The yen's crisis is a huge signal of a global shift away from paper wealth and towards real, physical things. I mean, in a world where real stuff is getting harder to come by and supply chains are fragile, you have to ask yourself, what is any paper money really worth?